Concerning new data reveals that the US economy is about to enter a severe recession. We're still in the early stages of the economy spiralling out of control, but we've already seen banks failing left and right, the money supply contract at an alarming rate, and widespread layoffs begin to take place. The implications of this recession are unknown, but could be catastrophic for many people, and worst case scenario could lead to a complete economic collapse. So let's dive right into what's going on right now with the current data and what this could lead to in the future. The US is without a doubt going through a banking sector crisis right now, with consumer confidence in banks plummeting and customer deposits declining at an alarming pace. We've now seen numerous multi-billion-dollar banks collapse so far this year, some of which are bigger than those seen during the 2008 global financial crisis. The entire banking sector has not only lost nearly $2 trillion of value in lost market cap since the start of 2023, but has also seen deposits fall by around $1 trillion over the last 12 months, clearly showing a major loss of consumer confidence in the entire sector. And it's for good reason too, as 722 US banks have reported unrealised losses exceeding 50% of their capital, a truly crazy situation to be in. First Republic Bank was the most recent addition to the list of collapsed banks so far in 2023, a bank that was once worth almost $40 billion but has now been bought out by JP Morgan for pennies on the dollar. The share price of First Republic Bank started to decline around the same time that Silicon Valley Bank got into trouble and ultimately lost 90% of its value over a couple of weeks during March. The bank had continued to operate normally, however it had suffered 6 weeks of dwindling confidence, billions of dollars in withdrawals and a poor earnings report to add to this before the FDIC ultimately came in to seize the bank. The share price of FRB was $3.51 when it was seized, marking a 97% decline in value since the beginning of March and allowing JP Morgan to swoop in and acquire it for very cheap. Now, confidence in smaller regional banks has been shot ever since Silicon Valley Bank collapsed, and the collapse of First Republic Bank had some similarities to this. Instead of having a large portion of their assets invested in fixed income treasury bonds like SVB did, First Republic Bank had a large portion of their assets invested in mortgage loans. Now, rapid interest rate hikes have made this business model unviable, and the market value of these loans that they owned became much lower than what was on their balance sheet, with the deficit being $26.9 billion according to the Wall Street Journal. A bank run essentially took place between March and the end of April, with First Republic Bank seeing over 50% of their deposits withdrawn from the bank, while simultaneously their stock crashed by over 90%. They could not raise debt through issuing equity, and they ran out of money to keep paying out customers withdrawing their deposits from the bank, all of which ultimately collapsed the bank for good. And with 722 US banks also suffering major unrealised losses that exceed 50% of their capital that I mentioned before, it's fairly obvious that there are hundreds of other banks that find themselves in a similar position to the banks that have already collapsed, and things could be about to get very ugly. Customers are withdrawing their money from these smaller banks at a record-breaking pace, and these banks can't recover all of the money that they have invested in these low-yield assets that have depreciated in value. The likelihood of more banks collapsing is rising by the week as consumer confidence continues to dwindle and more start to withdraw their money out of these banks. As the pressure to pay out on these withdrawals increases, banks are reaching a breaking point where it's no longer possible and the only option is failure. Banks right now are also starting to reduce the amount of commercial and industrial loans that they are giving out, with the year-over-year growth of these loans decelerating quite rapidly down to 7.6%. A reduction in available credit for the commercial and industrial sector can lead to a credit crunch where businesses need money but can't get access to it. This stagnates and harms growth across the economy, and is the reason why historically, looking at previous times when credit has taken a sharp decline, it has led to a recession. These grey highlighted areas on the chart mark periods of US recessions, and there is a fairly strong correlation of bank loans making a sharp decline and turning negative year over year at the same time as the US entering a recessionary period. The truth is that society nowadays runs on debt, and the economy relies on it to sustain itself. If the availability of credit from banks continues to fall, then businesses are not going to have as much access to loans, which is likely to lead to economic contraction. The severity of this decline in loans being given out will definitely have an impact on how severe the next US recession will ultimately be. And to make matters even worse, last Wednesday in the Fed FOMC meeting, we saw the announcement of a further 25 basis point rate hike, meaning that interest rates will once again reach new heights and pile even more pressure on struggling banks. This now puts rates between 5 and 5.25% and means that they have surged by approximately 5% in just over a year, which is an absolutely unprecedented rate of increase. The last time the interest rates were this high was the peak of the global financial crisis, and even then it took a much longer time for the interest rate to actually climb to this level. Interest rates rising even higher devalues the types of assets that banks hold even more, including the likes of fixed income government bonds and mortgages, because it widens the gap between the yield that these assets are earning to the actual yield that can be earned in today's market. This in turn increases the balance sheet deficit that banks currently have even further and decreases customer confidence in the ability for their bank to actually pay out on their deposits even more, increasing the likelihood of bank runs taking place. Interest rates are not going to fall anytime soon, and we are likely to remain at this current interest level for a prolonged period of time, which means that banks are facing a painful period ahead of them where they're going to have to try and manage the situation and remain liquid enough to pay out on customer withdrawals. Now, during this same FOMC meeting, the Fed also announced that they will be continuing to reduce their balance sheet, aka continue with quantitative tightening and reducing the overall money supply. Since 2020, the Fed has printed trillions of new dollars that have all been pumped into the economy in a number of different ways that all fall under quantitative easing. Now, this easing stimulates economic growth and increases financial liquidity, which was great in the short run to help the US get through the pandemic years where we had widespread lockdowns and businesses not being able to operate properly. However, the sheer volume of money that was pumped into the system led to super high inflation, and the Fed have now been forced into quantitative tightening to tackle this inflation, the opposite of easing. We haven't seen a contraction in the money supply for close to a century, and there have only ever been a handful of times where this has happened. This includes the 1929 Great Depression, the 1921 Depression, and the 1870s banking crisis, all of which were periods that saw unemployment surge above 10% and numerous bank failures taking place. A declining money supply leads to less economic activity and lower corporate profits because there is less money going around the system and therefore less money available to be spent on goods and services. Now, when businesses are struggling, they are forced to downsize and make layoffs, which leads to a rising unemployment rate, which is of course a bad thing for the economy. Now, the unemployment rate is at historically low levels right now at 3.4%, far below the peak that we saw back in 2009 of 10%. But looking at the economic data, there is a good reason to believe that we could see unemployment exceed 10% in the coming years. Not only is the declining money supply a signal of higher unemployment in the future, but also the unemployment rate has a strong correlation to interest rates. Now, throughout history, we've always seen the unemployment rate follow interest rates on the way up and also on the way down, but lagging behind by a few years. And after this recent surge that we've seen in the interest rate over the last year, this is going to cause a massive shock to the labour market in the next year or so, and means that we are likely to see more widespread layoffs take place. The money supply is also highly correlated with the price of hard assets like real estate and stocks. And here you can see that as the money supply surged as a result of rapid money printing and stimulus checks, the median home sale price also surged with it. Now that the money supply has started to decline, you can see that the median home sale price has also started to decline as well, lagging behind slightly. Now, as quantitative tightening ramps up and we see the money supply contract further, we are very likely to see the housing market continue to decline as well as the stock market. The higher unemployment rate that we are likely to see is also going to contribute to an increased housing foreclosure rate, which could further exacerbate this crash in home prices. If more people are getting laid off and can no longer keep up with their mortgage payments, then an increased number of homes will be offloaded onto the market in housing foreclosures. Now, this drives up the supply of homes and puts more downwards pressure on home prices. In fact, I made a video recently specifically talking about why we could be about to see a devastating housing market crash soon, which you can check out by clicking on the screen right now. Aside from that, drop me a like if you enjoyed the video, that does help out a lot. Also subscribe for more videos in the future, and thanks a lot for watching.